I'm Adrian Manns, live from the Money Show in Seattle, Washington. Today I'm here with Mike Larson, the Safe Money Report, and he's going to talk to me about boring stocks and why boring stocks or boring symbols might be the good ones to be in right now.
Yeah, it's kind of funny. I mean, you know, in this market environment with a slowing economy, with the talk that the Fed may be looking to cut interest rates again, kind of giving up on that rising rate cycle, it's the companies that are defensive, that are yield-oriented, and that offer sort of business models that will still be okay, still be able to generate sales and earnings even in a slowing economy, that are outperforming. And that's a big difference from what we saw, you know, really all the way from March 2009 when this bull market got started until January of 2018. It was the growthier, more offensive type companies. But really it's those defensive plays, again, utilities, consumer staples, REITs, for example, that are outperforming now, and I think are likely to continue to do so as you head forward into later in 2019 and 2020. So that's why at the Safe Money Report, we're just trying to be more defensive and keep that in mind.
So what are some of your favorite symbols right now?
Sure, I think there's a company like NEE, Next Era Energy. They're one of the largest utilities in Florida and really all over the country. Got a lot of solar and wind generation type projects underway. And that company, it doesn't have a great yield. It's about 2.5%, 2.6%, but that is better than you're going to get in the S&P. And the stock has been hitting new highs because, again, it offers that sort of defensive, yield-oriented, basic business that's going to still be there whether the economy slows or not.
So, and consumer, how do you feel about the consumer discretionary sector now with all the tariffs and the geopolitical stuff that's going on?
Sure, you look at, you know, the threats to maybe the retail sector. I mean, these companies that are importing goods that are going to be more expensive, that's a real issue. So those discretionary companies are less attractive to me than, say, your consumer staples. I mean, a company like Clorox here is one that I have in the Safe Money Report portfolio. It's not an exciting business. It's bleach, it's cat litter, things like that. Right. But it does have a decent yield. It's been raising its dividend consistently year after year. And it's a company, again, whose products are going to be necessary and needed regardless of how strong or weak the economy is overall.
So, and then overall, what are you doing with, let's say, all these market tops that we're putting in right now? So it's a lot of conjecture that the market's about to take a little bit of a tumble. Does it worry you? Or?
Yeah, I think, you know, really, I was very offensively oriented up until about January of 2018. Again, the types of things we invested in were riskier, were you know, semiconductors and insurance companies and things like that. But since that early 2018 timeframe, I've been much more defensive. And I think you're seeing this sort of broad topping pattern in the market where, again, defensive companies are doing better. You see some volatility starting to rise in the market, and credit spreads in the bond market. Some of the riskier bonds are starting to see a little bit of, or come under a little bit of pressure. So I think all of those signs tell you as an investor, it's not the same market that we had for that period up to January of 18. It's really a market you've got to take some different strategies to help prosper.
All right, more with Mike Larson in a minute. For the Money Show, I'm Adrian Manns.